The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome. You're watching Financial Planner, and over the next half an hour we're going to talk a lot more about mutual funds. Yesterday we spoke about sectoral funds, and today the focus will be on thematic funds. Joining us today is Hemant Rustagi, CEO of Wiseinvest Advisors in our Mumbai studios. Thanks, Hemant, for stopping by. Hemant, just to get started, yesterday we did talk about sectoral funds and how they're important and who should be looking at them as an investment option. What are thematic funds? They sound so similar to sectoral funds, and I'm guessing there's a thin line between the definition of the two.
We are absolutely right. They sound very similar, but they're definitely different from sectoral funds. You know, in a sector, as we discussed earlier, sector funds invest typically in one particular sector. When we talk about thematic fund, they follow a theme. Now, basically, the objective here for the thematic fund is to try and get advantage from the emerging trend, which could result in outperformance of certain sectors or certain companies. So clearly, the key factors are those that can make a substantial difference to the business profitability and the market values. The focus, therefore, is on structural and cyclical factors rather than looking at only one sector. So they are more broad-based, I would say, as compared to a sector fund.
So that's, of course, the difference between a thematic and a sectoral funds. Can you help me understand this with more examples, because it's still a little more complicated than it sounds?
Well, there are actually a lot of examples in the marketplace today. The most prominent ones are infrastructure fund. We saw a sea of infrastructure funds hitting the market, a few years ago. You have these lifestyle funds. You also have these global funds, and you also have this natural resources fund.
Right.
So these are like the major examples of thematic funds in the marketplace.
So so of course, will a thematic fund invest across the board? Will it be across large cap, mid cap, small cap, or would the focus be on one specific vertical?
No, like I said, what happens is in a sector fund, as we discussed earlier, you are investing in a specific sector. Here, because you follow a theme, the theme may spread across various sectors and various segments of the market, namely large cap, mid cap, and small cap. So in that sense, it's definitely more broad-based. But if you compare these funds with a plain vanilla diversified fund, they do not provide you that much diversification, because the major advantage for a fund manager in a diversified fund is that he has the freedom to move across different market caps as well as different sectors. Here, as compared to sector fund, there is more flexibility, but it has to be within what has been defined as a theme.
Right.
The fund manager cannot go outside that. So in that sense, there is some restriction on it.
Is it less risky than sectoral funds?
Yes, definitely. Because like I said, because they are more broad-based. In sector fund, you're investing in one sector. Here, like I said, you are investing it, across sectors and across market caps. So definitely less risky than sector funds.
Right, Hemant, also, but I'm guessing there are still some risk involved in investing in a thematic fund. In your opinion, what are the key risks that are involved?
Oh, there are definitely. One is that by nature, thematic funds are risky. Because, like I said earlier, if you compare the diversification level with a plain vanilla diversified fund, you don't get that kind of diversification. So one, that risk of diversification is definitely there. The second is the market may take more time to realize the potential of the theme, which has become the basis of launching a thematic fund. But there are examples we have seen where a fund has launched a thematic fund, but the market didn't respond as envisaged by the fund house. So there is always a risk, when you invest in thematic fund. There is another risk of, a fund manager style becoming too individualistic.
Right.
Why it happens is because, the investment strategy in the universe is not very clearly defined as compared to other funds. So there is always a fear or a danger that the fund manager may have his own style of, fund management.
Right.
But that becomes a problem when he leaves the fund, and when you have to get another fund manager to replace him. It may be very difficult for the fund house to get another fund manager who may think exactly like this, because this may not be process-driven, all the time. So there are a couple of risks where one should be aware of before investing in thematic funds.
Right, Hemant, so what if I'm just going to use this as an example. What if somebody is looking at an infrastructure fund? How does that become a sector fund, and how does that play out as a thematic fund? Because I'm guessing there'd be an overlap there, right?
Oh, yes, absolutely. Actually, the way the mutual funds are looking at infrastructure, they're looking at infrastructure as a theme.
Not as a sector fund.
Not as a sector.
Okay.
Most of the fund will have some core investment in the, let's say, in the infrastructure sector.
Right.
So that varies from, could be 60% to 80 to 90%. So one has to look at how infrastructure has been defined by the fund house. I mean, there are examples of infrastructure fund in the marketplace today where they're investing in the core infrastructure to the tune of 60-65%, and the rest of it is as diversified or even more diversified than a diversified sector. So one has to have a close look at, how the theme has been defined, and there can be actually ambiguity. That is another risk, as in fact we talked about earlier, is that if there is an ambiguity in the way theme has been defined itself, there can be problems. So you need to be very clear before you take exposure to any thematic fund.
So you need complete clarity and, of course, read the fine print, like they say, right? We talked about, of course, yesterday who should be investing in sectoral funds. What kind of individuals can look at a thematic fund?
I think it has to be, again, very similar to the investors who can look at sector fund. As I said earlier, thematic funds too are quite aggressive, can be risky, they can be quite erratic in performance. So only those investors who are comfortable with equity as an asset class, who have a fairly diversified existing portfolio, and who have a sufficiently large portfolio should be well looking at this. But here again, like sector fund, the exposure has to be restricted. To my mind, I think one can, as a thumb rule, look at 10 to 15% of the portfolio in such fund, all put together. It should not be more than that.
Hemant, also, I mean, with the world getting smaller by the day, it does seem like global funds have become quite easily available in India, and a lot of people are trying to understand more about it. Tell me a little bit more about global funds, because that's, of course, thematic in nature, right?
Oh, yes, they are. They are thematic in nature. In fact, global funds, I would say, have been a great addition to, the offerings of mutual funds. But here again, what we need to understand is most of the funds which are available in India are either investing in a sector or in a commodity. So in that sense, they are more of a niche product than a diversified fund. Actually, why would somebody look at global fund? Is because they provide you very high level of diversification. The reason being that you're investing in international markets. But it's not to say that there are no risk involved. There are definitely risk involved, because there are country risk. There's also a currency risk. So there are a couple of risks which are involved in investing in global funds. So one should be a little careful again. This again, I would say, not good for retail investors, not for someone who is beginning to invest or beginning to build up his portfolio. Again, only for experienced investor who can invest a significant amount to actually benefit from diversification in the real sense, rather than just at random investing some money and including one more fund in the portfolio.
Right, Hemant, also very quickly, I know global funds is what I might be coming back to, but in terms of, say there's an experienced investor out there, how much allocation would you say is advisable on global funds?
In my view, like I said, sector fund, thematic fund, any kind of thematic fund, as a thumb rule, should not be more than 10 to 15%. But of course, a lot will depend on the kind of investor you are. If you're an investor who understands what the themes are, someone who understands what the sector is, or for example, if you're talking about a global fund which is investing in a particular commodity, because these commodity-related global funds have done very well, because we have seen gold funds doing very well, and the natural resources fund doing very well. So if you're an investor who is aware of the risk or the pitfalls associated with it, and has the risk appetite to go for even higher allocation, you can. But in any case, I think it has to be in a restricted manner. One shouldn't go really overboard and make it as a bread and butter of the portfolio.
Right, very lastly, Hemant, in your opinion, what are the good thematic funds that investors can look at right now?
Well, I think if you really want to take a slight contrarian call, I would say you can look at infrastructure fund. Why I'm saying contrarian is because I feel that it will take some more time for the government to really act on what they need to do in this sector. In the last 3 years, these funds have actually hugely underperformed a broader market and a diversified fund. But if one has the patience, one has the time on hand, you can look at infrastructure fund. I think they can be a good addition to the portfolio.
Right, that's of course the advice coming in from Hemant, and a little more explanation and details about what a thematic fund is. We'll slip in a break, we'll come back and take up all your financial planning queries, so stay with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back, you're watching Financial Planner.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Hemant, we've got a query coming in now from an investor who's about 30 years of age. And of course, he writes in saying he's married, he's got a 3-year-old son as well, and his salary is about 60,000 rupees per month. He also goes on to say that he's purchased life insurance for 10 years and planned a PF to gain maximum tax benefit. He's paying about 13,000 rupees on his EMI for his home loan, and he does pay a tax of about 40,000 rupees per year. He would like to understand what else could he look at to save taxes and plan his finances better.
I think there are quite a few options which are available to save taxes today. I mean, if you look at what you can do under Section 80C, there are quite a few options. You can, whatever money you invest in your provident fund, that is eligible for tax exemption. Then there is PPF. Then there are also equity-linked savings schemes, which are launched by the mutual funds. There you can, save taxes. But of course, being an equity-oriented fund, there are risks associated with it. Then whatever premium you pay as life insurance cover is also eligible for exemption here. So before you look at other options apart from what you're already doing, because you also have a loan here, so clearly in that case, under Section 80C, whatever money is being repaid as a part of the principal amount, that is eligible under Section 80C. Okay. In fact, in addition to that, the interest up to 1.5 lakh is also exempt from income tax. Okay. Then there are also infrastructure bond under Section 80C CF, where one can invest up to 20,000 rupees and claim tax exemption. So there are quite a few options which are available. Of course, the choice will depend on how much you have already committed to options like life insurance cover, because that is a mandatory kind of payment. You have to make it every year. Right. Provident fund, PPF also, because a 15-year commitment. So whatever you're investing, you will continue to invest that. Once you have done that, then look at other options. Right. But on the longer term, I would say that if you're looking at planning for the longer term, because it also makes sense to make tax savings a part of your overall investment portfolio, I would then suggest that he should wait for a couple of months, see whether the DTC gets implemented from 1st April or not, and if it does, then see in what form it is implemented, because there might be some changes in the way you can save taxes. So wait for that for the longer term. Right. For the current year, like I said, there are many options depending on how much he's investing in different options.
Right. And also to plan his finances better, do you think, you suggested SIP being the best route to do that if he's planning his finances, of course, with the additional money that he saves?
Well, yes, definitely. Because if you're trying to build up a corpus through smaller contribution, the best way is to invest systematically. Of course, the choice of fund will depend on the kind of investor you are and how much your time horizon is. If you're investing for a longer term, it is always advisable to look at equity and equity-oriented funds. It could be equity-oriented balanced fund, it could be equity-oriented mutual fund itself, but look at those funds to begin with that have a bias towards large cap stock. Do not go for very aggressive fund in the beginning itself.
Right. Hemant, also moving on from there, Anshul writes to us and she says that she's given us the breakup of her salary and expenditure. She makes about 53,000 rupees per month. She's got a home loan as well of 22,000 per month. She's got insurance of about 35,000 annually, car insurance of about 18,000 annually as well. She'd like to know what you're making of this, and of course, if you've got any options for her that she can use the additional money that she's saving to generate wealth in the long term. She's, of course, already invested in a home, which is, in your opinion, the most important thing for a person.
What the best thing that she has done is, I think I would say there are, in fact, two things. One is to invest in a house, which is very, very important. The second is to go for a term plan. I'm assuming that it's a term plan, which will cover, her housing loan as well as, like I said, maybe 8 to 10 times of her annual income. So these two things, which are, like I said in the beginning, one must look at before you start, planning for your investment. Well, as far as the investments are concerned, I think there is a process that you need to follow. And that process is, first you define your own investment goals. All of us have different goals. We have short-term, medium-term, long-term goals. Once you define them, assign them a time horizon, which is very, very important, because that, and then set a target. For a long-term goal, I would say that you must consider inflation, take inflation into account, because if you don't do that, there's every likelihood that you'll have a shortfall after 10 to 15 years. So you define your goals, give them a time horizon, and then, because that will help you in deciding what kind of asset allocation should be there in the portfolio. When you invest for a shorter duration and a medium-term duration, the focus has to be on capital protection. When you invest for the long term, the focus has to be on beating inflation. So once you do this exercise, you know exactly how much money has to go into debt and how much money has to go into equity, and then the selection of funds will come. Unfortunately, many investors first jump to selecting the funds and then look at asset allocation, which is not the correct way. So if you follow a process, and I think maintain that discipline of investing as per your original investment plan, there is no reason why you can't be a successful investor.
So obviously it's all coming back to knowing your goals and what that matters. So once you've
Absolutely.
got that right, then you get your time horizon on track and then your asset allocation.
In today's time, it's absolutely important that you actually follow a goal-based investing.
And then everything else falls into
Because you follow a haphazard kind of strategy where you don't know whether you're investing in equity or debt.
Right.
Once you know exactly what you want to achieve, how much money has to go into asset class,
And then you
like I
work
said, there's no way you will not achieve the success that you're looking for.
Right, there you go, Anshul. Figure your goals out because that's important, and then of course you can work backward and then determine your asset allocation depending on the time horizon that you've got to meet those goals. We'll slip in a break, but when we come back, we'll go back to taking up your financial planning queries, so stay with us.
The Financial Planner, presented by the Bombay Stock Exchange, IPF. The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back. You're watching Financial Planner. Hemant, we've got a query coming in from Jaideep now, and he's 35 years of age. He's single and seeking your help for financial planning. He says that his salary is about 40,000 rupees per month. He's got an LIC of 12 lakhs. He's got a PPF of 10,000 per annum. He's got a Mediclaim from the company of up to 4 lakhs. He's got no personal Mediclaim, I'm guessing. He will also want to know about recurring deposits and whether or not that's a good investment opportunity. SIPs, he just says he doesn't have one, but he would like to opt for one, whether or not he should be looking to opt for one, and what, of course, are the other options available for his investments.
Well, let me begin with the risk cover. Okay, I think his life insurance cover is around 12 lakhs, which definitely is not adequate.
No.
Considering that his income is around 4,80,000 annual income, it should be somewhere around 48 to 50 lakhs. So clearly there is something that he needs to do over there. He should go for a term plan there, and for maybe another 38 lakhs. And there, I think that will cover his risk. On the health insurance side, I think he has a policy which covers around up to 4 lakh, which I think is adequate. So I think the risk has been covered adequately once he goes for this term plan. On the other side, where he's talking about recurring deposit. Now, recurring deposit, as we know, is a traditional investment options. Well, they do give you a fixed return. You know when you're investing in recurring deposit how much return you will get. But I don't think they're really a great investment option for someone who is in the higher tax bracket. The reason for that is they're not tax efficient. So every single penny that you earn as a tax, as per the current rule, you end up paying tax at your prevalent tax rate or applicable tax rate. There are other options from mutual fund which can be actually much more tax efficient, where you can also get higher return than what he's getting right now. He could, depending on the time horizon. If he's looking at again 3 years or 4 years of kind of time horizon for investing through recurring deposit, he can look at, as we discussed earlier, one, short-term funds. Okay, there are short-term debt funds he can look at, or he can look at debt-oriented hybrid funds like monthly income plan. Go for these if the concern is the capital protection. Yes, MIPs have some exposure to equity, but then if you invest only a certain portion of your portfolio there, they have only 20% exposure to that. So you can restrict your equity exposure by investing like this. At the same time, you can get higher return. For SIP, as I said, SIP is someone who's beginning to invest. SIP, you need to be very clear about your time horizon. The second is invest in the fund which have bias towards large cap to begin with. Go for diversified fund. Maybe you can look at fund like HDFC Top 200. This is a fund which invests 85% money in large cap, 15% in mid cap. There's another large cap oriented fund which is ICICI Focus Blue Chip. As the name suggests, it invests in the blue chip companies, but the investment strategy is slightly different. It actually takes a concentrated bet. So a combination of these two funds, I think, should be ideal for him.
Hemant, very lastly, we've got another query coming from Amar, and he's given us details. He's 30 years. He's got about 3.5 lakhs of liquid contingency fund in his bank. He's got a salary of 54,000 post-tax per month. He's got a bonus of about 12,000 per quarter. His monthly expenses are 25,000 per month, so he's landing up saving quite a bit of money. He's got a health insurance cover from his employer. He's got an FD of 5 lakhs at 8.5%. He's got an LIC of 1.4 lakhs, which probably needs some advice on. He's got an SIP of 30,000 per month on a 5-year plan. So their savings per month is about 15,000 plus his 12,000 rupee bonus that comes every quarter. Lots of goals. He's looking at getting married. So that's important. He's looking at buying a car for about 5 lakh rupees, buying a house of about 50 lakh rupees, and he also wants to do an executive MBA. What is it that he should be looking to do? Because he's pretty much listed out everything that we need to know about him.
I think one good thing is that he's very clear about what he wants. Maybe the goals are a bit too many at the moment, but he's very clear about what he wants, and he started the process. One good thing is he started the process. But as you rightly said, again, I think he's underinsured. He needs to definitely have a relook at the kind of insurance cover that he has. He can go for a term plan there. I think the current cover that you have is definitely not adequate to the kind of risk cover you should have. So have a look at that. As far as your other investment process is concerned, a lot depends on what he wants to do in terms of doing executive MBA. He's also mentioned that maybe he wants to go abroad for doing that. If he does that, in that case, clearly everything has to be reworked. So I think the first priority has to be make a decision on what you want to do with your career. I think it's very important. You're young at this stage, and you have created a basically emergency fund, which I think he's going to use for his marriage, which is going to take place. So that part is absolutely fine. But I would say on the longer term basis, make a decision, career decision first. And once we know, because if you're going abroad, then you'll need a lot of money. In that case, when you come back and you start reworking, depending on your salary level at that point of time, the first priority, of course, has to be to repay that loan. And depending on how much you will be having after repaying the loan, I think you need to plan then. It will be a little too mature to plan his investment today, unless and until he has taken his decision in terms of career.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
That's, of course, crucial for you to understand. Plan your career, determine when you want to do that executive MBA, and then, of course, work towards how you want to save up and take that ahead. Well, that's all the time we have on this edition of Financial Planner. Thanks for watching. A lot more programming lined up, so keep it with us. Thanks, Hemant, for joining us as well.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.